When the Fed raises rates, your loan and savings rates can change fast. The federal funds rate doesn't equal your mortgage rate, but it sets the floor for almost everything banks price. It quickly shows up in credit cards and other variable APRs, and it influences savings APYs because banks adjust what they'll pay for deposits. Changes can feel instant because new rates apply to new purchases, new loans, and rolling terms. That's why every borrower feels it, and why a higher FFR can widen a bank's profit margin between loans and deposits. The federal funds rate is really about how banks fund themselves overnight, which is why it ripples into your everyday money costs. Banks that hold reserves lend to other banks that need reserves to settle payments, and those loans are typically overnight. The Fed sets a target range, not one exact rate, and the market trades inside that band. The Fed steers it using interest paid on reserve balances, which helps control where that overnight rate lands. When the FFR increases, the first thing that reprices is overnight funding, and then the ripple moves outward. The prime rate usually moves quickly, which matters because many consumer APRs are set as prime plus a margin. Variable rate loans often reset monthly or on a set schedule, so the higher cost shows up soon. Credit cards can reprice more slowly because of statement cycle timing and notice rules. Deposit rates usually lag, and the pass-through is rarely one-to-one. A rising FFR mostly changes your life through timing. Variable debt moves fast, and fixed debt moves later. HELOCs, adjustable rate mortgages, and many business lines react quickly, while new fixed-rate loans reprice as markets adjust over time. Savings rates can rise, but unevenly, because banks don't all need deposits the same way. You can ask your bank how it sets rates and amortizes into margins. Refinancing math also changes because fees and the reset schedule matter as much as the rate move itself. If rates are rising, treat it like a household audit. Find what will reset and act before it does. List every variable APR you have because a small increase on a high balance adds up quickly. Put extra payments toward the highest APR first, and if refinancing makes sense, start before more resets hit your payment. Move idle cash into a better paying account today, avoid taking on new variable debt, and review fees, holds, and minimums that quietly drain cash flow. A single 1% APR increase adds about $100 per year for every $10,000 you carry in variable debt. BankingHub can match you to accounts based on how you actually bank and show the real dollar impact for your balance. Free, takes about 2 minutes, and the link is in the description.